every deal has to be measured not only as in this is the numbers on paper, but it also has to make sense in the context of which it's been purchased. So if I have a 240 unit property in a certain location and there is a 20 unit across the street, the same deal would be much better for me because I already have a full-time staff across the street, right? Versus to someone from another state.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. I know that for some of you out there, you want to leverage real estate to get out of your day job and really find financial freedom. Now, I can tell you firsthand that it's not without its challenges, but it's certainly 100% worth it. The key is to drive through those challenges you're going to encounter and getting creative to do whatever it takes to get your first deal done and break through all the roadblocks, the negativity, and the frustrations. Well, today's guest understands this very, very well. After spending a lot of time in the single family space, he found that there is much more value to be gained in multifamily, but he had to persevere for years before nailing down his first deal. Now, he spent over 17 years in corporate America where he enhanced his business acumen, his analytical skills, and developed his big picture perseverance. All these skills that he currently leverages today. Now, eventually, he left corporate to focus on his multifamily real estate business. Today, as the founder of EBG Acquisitions, he leads portfolio acquisitions, capital raising efforts, and deal underwriting, as well as, of course, asset management services. He is also the author of the book, The Real Estate College Fund, and helps investors recognize the advantages and the risks of investing in real estate and offers ways to really help mitigate those risks. Now, with all that, I'd like to welcome my good friend, Joseph Gozlan, to the show. Hey, Joseph, thanks for coming on, man.
Thanks for having me. It's a pleasure.
Yeah, awesome. Now, if you like what Joseph has to say, you can reach him via his contact page at ebgacquisitions.com. And if you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Joseph, go ahead and tell the listeners a little bit more about your background and how you got started in real estate.
Yeah, so thank you again for having me here. We actually have not been in the United States from the beginning, right? We haven't born here. Both me and my wife moved here back in 2007. But we started as students back in Israel, reading Rich Dad Poor Dad. And that kind of triggers, like a lot of other people out there, it triggers that different mindset and a different thinking. And we got married. And in Israel, it's very common to buy a condo after you get married and move in. And we found one, but it was a large condo. It was like 3-4 bedrooms. And at the time, my wife and I were living in like a 600 square foot rented apartment. And it kind of triggered us to say, okay, we can move in, incur the extra cost, the mortgage, the taxes, the utility bills, or we can use what we just learned on Rich Dad Poor Dad and just rent it out until we're ready to move into it. Long story short, we never ended up moving into it because we moved to the United States and it stayed just an investment property from the beginning. So you could say we got started accidentally, but that was the first potato chip in the bag, right? You can't just have one. Real estate is just like a bag of chips. So that's how we got started. We moved to the United States. We both got licensed just because we wanted to continue investing in real estate. And we kind of looked around. We didn't know it's a different system, different laws, different everything. So we felt the right way was to get licensed as real estate agents in Texas. So that's what we did. And then our daughter was born about a year later after we moved in. And I'm sitting at the hospital. I'm looking at this helpless creature in my hand. And I'm thinking, okay, yeah, well, I'm an engineer. Mom's an engineer, right? You will go to MIT. So I open my laptop. Everybody's sleeping. I'm just doing the math. It's like, holy crap, it's going to cost more than $1 million to get you through MIT. So that was basically the seed of my book you mentioned earlier, The Real Estate College Fund. It's kind of like, there's no way I can save $1 million in 18 years, right? The math was basically, you got to start putting aside more than I was making at a time. So real estate was what I found as the best vehicle to get to that $1 million. If you bought a property 18 years ago and you let it grow, somebody else pays the mortgage, and you get money all along the way. When she's going to be older, she's going to get the keys, and she can either use the income from the property to pay for her tuitions, or she can sell it to pay for the entire thing, right? So that's how we got started, right? We've gone through a lot more since then, but that's how we got started.
Excellent. Excellent. Yeah. I mean, it's sometimes it's those realizations, right? When you realize to put your kid through school, my God, it's, for me, it started off with a single family home. I was actually planning on buying single family homes too, back a long time ago, for my kid, who's now, we actually had one, later on, my son. And yeah, I'll tell you, man, it's, you realize how expensive schooling is, but then, like you said, once you realize the power and the potential of real estate, you can't just do one, right? It becomes much bigger than that. It becomes much bigger than that. So, but it sounds like you got into the single family space. You're doing that for a littion bit, but then you eventually transition to multifamily. Like, what was the big leap for that? Like, what did you realize? How'd you figure that out?
Yeah, so the breaking point for us was the lack of sustainability in the single family space. So we had a property that needed to have foundation adjustment. In North Texas, it's very common. It's kind of like a sandy soil, so houses settle, and every once in a while you gotta raise them, right? But when you raise a 1970 house, the plumbing underneath it is cast iron. And the only thing that keeps it in place is the pressure from the soil. So as soon as we raised it, the whole plumbing went apart, just fell apart. And we had to not only pay for the foundation fixes, we had to pay for an entire plumbing on a 3,400 square foot property. And then same year we had hailstorm that took out the roof in that property. And we had insurance, of course, but we had to pay deductible. And we had a water heater burst that took out some flooring. So that was like $45,000 expenses in a 6 months period. And then at the same time, we had another property that needed a fence. That's another $7,000. We had a property that needed an AC unit. That was $3,500. And I'm looking at my wife and it goes, that's not sustainable. Right? It's like there's not a lot of people that can just write off $60,000 checks at once. And lucky for me, I've built that reserve fund for these things, but it basically wipes away 5-6 years worth of cash flow. So I'm sitting down and it's like, okay, Kiyosaki fooled me. He promised me cash flow. It's like, well, I had cash flow for 5 years and now it's wiped off. So now what? Right? And then that's where the engineer in me kind of kicks in. And I went out and I researched like everything, anything you can think of, whether it's real estate or non-real estate or commodities, oil and gas, forex trading, everything. And came to the same realization that there's nothing better out there than real estate. And then dove into all the different real estate asset classes, from commercial, retail, and restaurants, and office, and medical, and building, and industrial, whatever you want. Multifamily was the one I could connect the most. It made the most sense to me. It's, in my opinion, one of the last asset classes that will ever get disrupted. Because think about it this way, right? It's 2020. We're all going through the whole COVID situation. Retail took a massive hit. Office took a massive hit. Medical, ironically, took a massive hit. But people still needs a place to sleep.
That's right.
That
That's
doesn't
right.
change. People needs a place to shelter in, right? People needs a place to quarantine in, and so on and so on. So it's kind of like I felt that it's the most resilient and most reliable asset class, and that's where we decided to go into.
Yeah, yeah, yeah. And then taking a step back, when it comes to the single family space, it only took one of those things to really wipe out your cash flow, not just for 1 year, but even up to 5 years, depending on what it is, right? I mean, because in a
Yeah,
single family home, even if you have a mortgage on it, you might clear a couple few $1,000s on it, right?
a year. Yeah,
Yeah, a year. And it's like, so if all it takes is a boiler, a roof, or whatever to go out at the same time, next thing you know, yeah, you're eating up all your cash flow for maybe 2 years or more, actually, depending on how bad the damage is. I think when it comes to that realization, it's quite easy to figure out I got to do something else, right? It's just not sustainable.
Yeah.
Absolutely.
And multifamily is all about spreading the risk, right? If you have a single family house and your tenant moves out, you have 100% vacancy. Until you put a new tenant in place, you have to pay the mortgage, you have to pay the insurance, you have to pay the realtor to release it for you, you have to pay the utility bills, you have to pay everything, right? If you have a duplex and one of them moves out, you have 50% vacancy. And if you have a fourplex, it'll be 25%. If you have 100, it's 100% right? Of your occupancy. So if you have 100 units, you can have 10 vacant units and still be fully profitable. Still enough money that comes in and pay the mortgage and pays the salaries and pay the expenses for the maintenance and the bills and everything else. And you don't have to pull anything out of your pocket, right? So on the singles, there have been multiple situations where I had to pull money out of my pocket temporarily, right? Because it's always bringing money to your pocket, but every once in a while you get one of those big ticket items, you have to put money out of your pocket in order to fill this back up. On the multifamily side, rarely ever happens something like that.
Yeah. So good. So you make the realization. Okay. So now you're going to get into multifamily. So let's talk about what's your first multifamily deal, or one they actually want to talk about. Let's go with that.
Well, no, my first one was I'm still proud of it, right? It was a great one, but it was probably the hardest one to get because when you step into the multifamily world, now you're dealing with commercial brokers. And I know there's a lot of people that think multifamily, 3 units is multifamily. It's like usually when we refer to multifamily, we refer to 5 plus. Anything 1 to 4 is considered residential. So it gets a lot harder to find those deals. It gets a lot harder to get the time of day out of those brokers, getting them to even respond to you, to connect with you. Um, so it was really hard to stick my foot through the door. But like I said, I'm a licensed agent. So at some point I said, you know what, the hell with it. I'm going to go and source it myself. So I started sending letters and yellow letters, postcards, making cold calls until I land. And I talked to a few owners along the way, and some of it was too big, too small, too far, until I landed on the one that was kind of like the perfect fit for me. Went out to meet the guy who's like an 80-year-old guy, have been a custom home builder for decades. He built the property himself. He was anal about everything. Like everything had to be in the shop, had to be hanging in the same spot. Well, I had the blueprint, the original blueprint. That's what
Wow.
I got when we bought the property. He was going out there changing locks, fixing little things. He was leveraging a realtor to help him lease. So while the property didn't need any investment in terms of rehab, there were so many inefficiencies in the operations that I saw I could easily add value in that property. So got to talk to the guy, negotiated a price. We got to know each other so well and build a rapport so good that he offered seller financing. Um,
Nice.
so that was a great. He's kind of like World War II generation. You can have a deal with him on a handshake and go to sleep safe and sound, right? He was that kind of guy. Later on, after we've closed the transaction and everything, he told me that he had higher offers, but he chose to give it to me just because of the relationship we were able to build. Um, and I knew that he had a lot of emotional attachment to the property. So I told him, look, just, for the first whatever months you feel like it, you can go out there and you can keep talking to the resident and you can go. I let him keep the keys to the shop. If you want to do any fixes, any changes, just go ahead. I gave him full access because, again, I knew I can trust that person blindly. Um, and honestly, there's not a lot of people out there that I would say that about. Um,
Well, Joseph, there's a lot to unpack there. So you took the initiative to source the deal, which takes longer to do. But then it's interesting. You built the rapport and you got them to carry back the note, which is another option that many people sometimes they consider that. Most times they go to a lender. So the fact that you're able to get a direct relationship with the seller and demonstrate your ability to perform, that was huge. That's excellent because you don't have to go through the quote first timer of dealing with a lender and all that fun stuff. And I imagine the deal size, like how big was it?
It was 1.6 million.
Okay, so it was a fairly smaller deal, and you probably can't. Well, it's tougher to go to a broker for that because you're paying the broker fee on top of it, right? And as opposed to going to a normal bank, a local bank, which is going to charge you, you better hope to God that they'll close, right? Because sometimes those local banks, they'll wait till all the way to closing day, then they'll pull the plug on you. It has happened. It happens all the time for those of you guys listening out there.
Yeah, it does, and I kind of dodged that bullet, and we were able to do a few things, right? So one of the things I really love about real estate is you can get creative,
Yeah.
right? So I had enough money for a 25% down payment that I basically refinanced my singles to get the cash, but I knew I'll need some money for operations. So I told the owners, the sellers, like, look, let's work it this way. I'm going to give you 15% down right now when we close. And then every quarter, I'm going to give you an extra $5,000 towards the principal.
Mm.
So I was able to get in until we hit the 20%, right? So I was able to get in with a lot less cash. And I also built a structure that allows him to get back to the 20% as soon as possible, right? Knowing that I reinvest back into this deal everything that comes out of it. So we did that way, and because there was no loan, we basically closed in 23 days.
Nice. But
So
that's an interesting structure there too. It's where you're putting down 15, usually you put down 20, 25%, or even 30% in some cases. You put down a little less, but then you made that promise to close that gap sooner than later, right?
yeah,
And that's beautiful. Beautiful. Nice.
and that's why I said real estate. You can get creative, right? It can be I'll give you $5,000 and my used 1993 Toyota Camry, right? You can do whatever you need to do, however creative you can be in real estate.
That's right. That's right. Awesome. Awesome. So let's talk about some of the deals you're doing these days. So that was your first deal. Do you still have that one?
Yes, I do.
Okay,
I
good,
still
good,
have
good.
that one. That was my first one. That one I have with no partners, and that one is probably it's my newest property. It's a 2007 build. So for me, that's a generational property. It's the location is great. It's 100% occupied. There's always a waiting list, so that property is not going anywhere.
Right,
Um,
right, right, right.
but
Especially if you're the only owner. Especially if you're the only owner. That's beautiful. That's great. That's
yeah,
super.
and since then we refinanced that one. We paid the seller everything he did. We took a lot of money off the table as well. So all in, I'm about $50,000 left in my own capital in there.
Wow. Awesome.
So that was a great property and a great first deal. And this is what I try to help our clients understand, because like I said, I'm also a broker, so I help other people buy, especially the smaller ones these days. I tell them, look, the first deal needs to be a deal that leaves good taste in your mouth. But if the first deal is going to be horrible, you're not going to have another one. Right? Back to the bag of chips example, right? If the first one tastes awesome, you're going to finish that bag. But if it tastes horrible, you're not going to take another one.
Right.
So
But Joseph, how do you know? How do you know if you got a good deal on your hands or if you got a crappy one on your hands? Like, how do you figure that out?
So that answer is a little bit more subjective. What would be a good deal for me might be a crappy one for you,
Yeah.
and the other way around.
Yeah.
So every deal has to be measured not only as in this is the numbers on paper, but it also has to make sense in the context of which it's been purchased. So if I have a 240 unit property in a certain location and there is a 20 unit across the street, the same deal would be much better for me because I already have a full-time staff across the street, right? Versus to someone from another state. And that's really where every deal has to be measured in the context of the person that is looking at it. There's a lot of people that are willing to that are saying, I'm willing to put the sweat equity, I'm willing to get into it, and then they find a deal that looks awesome on paper, but it's in a war zone.
Yeah.
And suddenly all their willingness for the sweat equity runs away real fast when you realize, okay, I need to get 2 German Shepherds and a shotgun to go collect rent, right? So that's really where what's good for me might not be good for you. So when we work with a client, we try to understand the client, their needs, the amount of time they want to put into it, and then we try to find them the right property. Um,
Yeah.
there's just so many aspects, right? If you're a real estate professional, you can buy a break-even property and still make money. Why? Because you can take the depreciation and apply it against ordinary income. So it's kind of like there's a lot of considerations. There's a lot of strategies. Are you a short time buy, fix, flip sale, right? Or are you, and that happens on multi-million dollar properties just as well as the single family, right? Or are you a buy and hold, right? So if I'm a buy and hold for long term, I want a nicer property. I want it in a better condition, preferably some property that somebody already spent millions of dollars already fixing it up, right? So I'll sacrifice some returns in the short term, but what I help people understand is multifamily is like wine; it gets better over time. So because rents are going to go up, your mortgage is going to go down, and you'll be able to get a lot more cash flow in year 2, year 3, year 4, year 5, year 6. So we try to put all these things into consideration when we actually help a client understand, is this a good deal for them or not?
Nice, nice. So, what sort of assets are you targeting these days? And like, what location, what asset class? Like, what are you going after?
So we're in Texas. We're usually our purchase criteria is somewhere in the B to C class areas. We don't care what the property condition is, right? We're not afraid of really heavy lifting. Our last project had $1.6 million rehab budget on it, right? So that doesn't scare us, but the location is super critical because that's the one thing we can't change about a property.
Mm.
So that's what we're looking at. We starting to graduate towards the B class properties because they're a little bit less of a pain. Uh, but right now with the whole COVID situation, we kind of took a step back a little bit, and we're trying to evaluate where and how we're going to resume acquisitions.
Right, and then you're still buying just in your own backyard, so to speak, right, and down your neck of the woods.
Yeah, so we're only buying Texas right now.
Yeah, yeah.
We
No,
didn't expand.
yeah, but it's funny, Joseph, because so many other people they get started in the C class, which nothing wrong with that. Many people. I mean, I still buy C class even today, but we make or graduate rather over to the B class stuff just for that same reason. It's a little bit easier to run and to operate. Just because you're not really worried about tenants punching holes in your walls and not paying rent on time and things like that. I mean, certainly you won't have the same cap rate and the same return, but you make up for it in terms of consistency, which is something that your investors obviously want, right? They love
Yeah.
that stuff.
One of the biggest benchmarks that I've learned to appreciate is headaches to returns ratio.
Love it, love it, love it. So, are you getting into any other assets besides this too, or
Um,
just strictly sticking with the multifamily for the time being?
for now, we're sticking with multifamily. If there's any other asset class that I have my eyes on, is industrial. The whole COVID I've had my eyes on industrial before COVID blew up, but COVID just accelerated what I've already seen before, and that is the growth of e-com. Right. So when the e-com businesses graduate from the garage, they need a 3 to 5,000 square foot warehouse. And when they get out of the 5,000 square foot warehouse, they need a 10 to 15,000 square foot warehouse, and so on, all the way up to the hundreds of thousands of dollars warehouses that Amazon is buying and Amazon is leasing, right? So anything that has access to transportation, like major highways, anything that is designed for these things. I also believe that with everything that we found or realized in the last few months about our manufacturing capabilities in this country, that there's going to be another step up in reintroducing manufacturing in the country. And there's also a lot of interesting trends going on in the world, like the whole concept of cloud kitchens, right? So if I want to have my own restaurant, instead of going out and spending hundreds of thousands of dollars on improving prime real estate in retail environment, where half of it is going to be wasted on the back end, the kitchen, the freezers, and so on, that I'm paying the same price per square foot for the back as much as I'm paying for the area I can put customers in, right? Um, I can go to a warehouse and create or lease a kitchen, and then just use Uber Eats and DoorDash and Grubhub to send my food to my clients. So
Mm.
the two big barriers that most people that had a dream of a restaurant are just now going away, and that is the cost of the barrier to entry, cost wise, and the delivery piece of it. Because you can ask every pizza shop owner what's his biggest nightmare, and that is the deliveries, dealing with drivers and all this, and getting there on time or everything. Well, that problem gets solved.
Now, getting back to the industrial, can you, for those that aren't familiar, then can you dig a little deeper as far as what sort of asset class would you be looking for if you were going to do an industrial deal, or if it got that far yet?
Well, what I would prefer to focus on is anywhere between 5 and 15,000 square foot on a major highway or with quick access to a major highway. That gives you a few opportunities. You can lease it up to an e-commerce shop that basically graduates from a garage or graduates from a 3,000 square foot warehouse. It allows you to split it to maybe 3 of those 3,000 square foot spaces for these guys. It allows you to 15,000 square foot is good enough, depending on the location and the way it's laid out, is good enough for a small venue. So if you want to host a little expo or host a little trade show or host anything, 15,000 square foot is a good size for the small event, especially in the smaller cities, right? So that's really where I would probably focus if I would go industrial these days.
Now, are you concerned about, let's say, well, when those places are empty, right? I mean, you're not going to have expos every week or whatever. Maybe you do. I don't know. I guess it depends on the area. But I guess one of the biggest hangups that many people throw out there is that, well, it's not cash flowing. They don't have the consistent cash flow that multifamily has. Like, how do you overcome stuff like that?
Well, here's the thing. When you depends on, again, on the kind of tenant that you bring in. The venue is just one side of things, right? But most of the time, you will have either a distribution location. It doesn't matter what size, even if it's 3,000 square foot, it's a distribution location for a small e-commerce shop, right? Or if it's a $50,000 square foot distribution center. Um, yes, you might be vacant for a year until you find the right tenant. But once you find that right tenant, they're pretty much going to stay there for years and years and years. So the years that comes after that of cash flow usually compensate for that first 6 months or 8 months until you actually find that tenant that moves in. The level of maintenance, and go back to headaches to return ratio, right? The level of headache that you will have from an industrial client is minuscule compared to 80 unit apartment complex or 100 unit apartment complex.
Yeah. Well, and the cost per square foot is also going to be less expensive too on an industrial asset versus that. So you're not necessarily spending a ton of money getting into a 15,000 square foot facility. Again, depending on where you're located, of course. But you're hopefully you have a Rolodex big enough that you can find someone to lease it up fairly quick. Is what it sounds like, right?
Yes, and if you are getting into this space, I would actually try to find the tenant before you close the deal.
Right. I was just going to say, yeah, because you definitely want to try to find that. The last thing I want to do is buy a 15,000 or 20,000 square foot facility and have it sit there empty for a while. And meanwhile, you're forking out money for payments. That'd be terrible. That'd be terrible.
Yeah. Unless you budgeted for it.
Yeah, unless you budget for it, or maybe you get lucky and you find someone that is willing to sell their property, and you can acquire it, and then maybe they do a lease back or something like that. So it gives you some time to find another person to do that deal. So, but why would anybody want to do industrial versus, like, say, multifamily? Like, is there, aside from the headaches, is there like any other upside or anything else like that?
Well, the multifamily space have become very, very competitive in the
Yeah.
last few years. And there's a lot of different investment strategies that moved into the market um, that most normal human beings like us can't compete with, right? There was a lot of foreign money that came in from multiple countries that came in and made those transactions that all of us locals looked at it and it's like, I have no idea how to do that, right?
Right.
I've seen a $30 million transaction trade at a 3.5 cap rate in Dallas. So it's kind of like you look at it and it's like, what's going on? And then digging a little bit later, it turns out Japanese investor. They have a tax rule back home that says if it's older than 1980 something, they can write it off, accelerate it in 2 to 3 years.
Oh,
He
wow.
didn't buy an investment property. He bought a tax write-off.
Yeah. Yeah.
Right. So how can I compete with somebody buying a tax write-off? So a lot of that, there's a lot of syndication groups that go out there and they buy sometimes indiscriminately. That would be another reason why I would look at another asset class, just because the multifamily space became competitive. But dollar for dollar, if I'm faced between $1 million multifamily or $1 million industrial, it's gonna have to have a lot more um, factors in the decision because it's not that easy of saying, "Oh, I'll go industrial." Well, I'm definitely more inclined to go towards multifamily.
Right. Yeah, I'd feel the same way. I'd feel the same way. Absolutely. So now, Joseph, what would be that one piece of bulletproof advice that you would give to that listener right now? So they heard your story, they talked about your struggle at the very beginning, and maybe now you're considering doing some industrial stuff. So after hearing all this, what would be that one piece of bulletproof advice that you give them? Like, what would you tell them?
Don't wait. So you mentioned earlier, I've been in corporate America for 17 years, and I suffered through a lot of it. If you have that entrepreneurial spirit, corporate America is designed to suffocate you. That's just the way it is.
I laugh because it's true.
and that's just the reality, right? You're probably not built into it. You're probably banging your head against the wall. You're probably fighting windmills throughout your entire career. So I would tell myself, don't wait. I would tell myself, don't be concerned, right? So we also work as a brokerage. We also work with smaller investors, right? That they're buying the first duplex or the first fourplex. And what I help them understand is kind of like a lot of them are trigger shy. And it's kind of like, look, when, at least in Texas, when you put the contract in, you have an option period. You'll have 7 to 10 days where all you're risking is $100. You're risking $100. Pull the trigger. Worst case, back out of it. But pull the trigger, because every step you make is another step forward towards your freedom. And we all have a different freedom number, right? A freedom number basically says, I can do whatever I want, whenever I want, with whomever I want. It does not mean I'm retired. It does not mean I'm sitting on the beach drinking Mai Tais, right? But it means if I want to take my family and work from Hawaii for a month after COVID comes down, then I can do that because it's a choice I can make. So, like I said, start sooner and pull the trigger.
Awesome. All right, guys, if you want to reach out to Joseph, you can reach him through his website at ebgacquisitions.com. And of course, if you're looking for some help and maybe get into your first deal, definitely reach out to him. Sounds like he can definitely hook you up on your next deal. So I hope you got a little bit charged up, seeing your dreams come come true is I could tell you right now, guys, it's the most amazing thing when you can actually build something from nothing. And real estate is certainly the way to do it. Thanks for tuning in. I greatly appreciate it. And I will see you in the next episode. Take care.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.